then we have the next pattern, which is a rounding bottom. And so this pattern, as you can see, is similar to the cap and handle pattern. The difference is the absence of a handle. The formation of this pattern occurs in a downtrend when the forces of the bears run out and the price has reached a local bottom in the chart and the bulls have become more active. And so after the consolidation of the asset in the side channel, the quotes break through the neckline level upwards and move in a corrective upward dynamics to the height of the formed pattern. And so the formation of a rounded bottom pattern is demonstrated, of course, here in this 30 minutes XAG-USD chart, which is, of course, a silver chart. And so after the quotes moved down, the asset found a local bottom followed by the consolidation of the instrument. And so then there is an impulse breakout of the price upwards and the closing of the bullish candle above the neckline level. And so now we could open a buy trade with the opening of the second candle. Target of the movement is indicated as the height from the support level to resistance level. Stop loss, on the other hand, in this case should be set below the neckline level. Okay, next one is double top. And so this pattern is often seen in lower and higher timeframe candlestick charts. The asset is forming a double top while trading in a channel between the resistance and support levels. After an unsuccessful attempt to break through the resistance line for the second time, the quotes turn back and overcome the neckline, which is the top of the support level. And after a successful breakthrough down and retesting of the newly formed resistance, the price moves further, completing the formation of the pattern. And so, again, you can see the great example here in this screenshot. It is the 30 minutes time frame US crude oil chart. And so in this picture, in this screenshot, you can see the formation of two peaks and an impulse breakout of their support level. Further, there is a consolidation of the instrument below and retesting of the new resistance. And the entry point is below the support level. And so, next, a conservative target is calculated according to money management rules, and the target size is equal to the height from the top support level to the resistance. And stop loss in this case should be set above the support level to help traders avoid losing money rapidly, of course. And so the double top pattern can be seen in various time frames and is a valuable tool in a trader's toolbox for identifying potential market reversals. So now we have next one, which is of course double bottom. And so, as you can guess, it is the opposite of the double top pattern, signaling the beginning of a new trend. And so as a rule, it occurs in the local base of the assets and tests the support level twice. And the development of this pattern involves a breakdown of the resistance level, after which the quotes test the broken resistance. After that, the price bounces higher to the level of the side channel high, which formed between the support and resistance lines. And so here you can see an example, of course, again in this pattern in this 30 minutes Ethereum chart. And so this screenshot shows the formation of the pattern. And after the formation of the second bottom, the asset rushed towards the resistance, which it overcame and tested again, consolidating higher. And so we could make a buy trade after the instrument consolidated above the resistance. And so the price movement are equal to the height of the side channel between the support and resistance lines. And so the trade could be closed at 2 points. Stop loss in this case should be placed lower in accordance with the risk management rules. So next one is bullish hammer. So the hammer pattern belongs to Japanese candlestick analysis and is characterized as a bullish reversal pattern signal. So, hammer candlestick is one of the best patterns for intraday trading. This bullish reversal pattern forms at a local bottom and signals a buyer dominance in the market. So, when trading this pattern, a trader needs to focus on the market situation as a whole. If before the appearance of the hammer the downward movement was strong, there's a high probability that after the pattern the bullish reversal and further movement will be just as strong. In addition, when trading this pattern, you need to start from support and resistance levels in order to determine the price dynamics more accurately. And so, the color of the hammer is not important, but the very structure of the bar is. However, a green candle, which is a bullish candle, indicates stronger buying power. So the name of this pattern comes from its shape, of course, a small body with a long wick down that looks like a hammer. And so again, we have the 15 minutes chart of CAD JPY, which of course is Canadian dollar against the Japanese yen. And we can see a signal within the day. The appearance of a hammer reversal pattern means that at this mark there is a support level for the asset, below which bears cannot go. And so the resistance is where the decline started. So the downward movement was strong, therefore the recovery implied a strong upward movement, and so a series of bullish patterns of hammers formed, after which the quotes reversed. A buy trade could have been made after the formation of the second hammer. Stop loss should be placed just below the low of the pattern. And now we move on, and we have one of the most popular ones, which is head and shoulders. And so the head and shoulders reversal pattern appears in the chart less frequently than other chart patterns. It forms three vertices, one of which is located in the middle above the other two. At the base of these peaks is the neckline, the support level. So, sell trades should be opened only after the formation of the right shoulder, the breakout of the neckline level by quotes from the top down, and the consolidation of the price lower. So in addition, the right shoulder should be slightly higher than the left one, but it is not always like that. But if you see that as I said, the right shoulder is slightly higher, therefore it means that this pattern is, we could say, more precise and therefore more accurate, and therefore the probability of working out of this pattern should be higher than without this level difference between the shoulders. So, in the event of a breakout, a short-term upward correction is possible to test the newly merged resistance. And so, the price movements are calculated as the distance from the neckline level to the head. In here, of course, again in the 15-minute chart of Bitcoin, there is a fully formed classic head and shoulders pattern. We could sell the instrument after the price fell below the neckline and the quotes consolidated below this level. Take profit could be set by measuring the distance from the level of the neck to the level of the head. And stop loss in this case should be placed just above the broken support level. Next one is wedge. And so, the wedge has several varieties, and this pattern can form in both uptrends and downtrends as well. Rising wedge in uptrends and downtrends signal an imminent trend reversal of the quotes. So, the falling wedge in both cases indicates an imminent breakout of the upper trend line. And so when opening trades based on this pattern, you need to focus on the formation height. You can see an example of the formation in this pattern of the JBP-AUD chart, which is basically British pound against Australian dollar. It is a 30-minute time frame chart. And so this screenshot shows that when the trading channel narrowed and the wedge pattern formed, there was an impulse breakdown of the price to the level of the formation height of this pattern. Only enter after a confident consolidation of the price and an increase in trading volumes. Stop loss in this case should be set above or below the broken level depending on the type of formation. So, next one is Pennant. The Pennant pattern is similar to the flag pattern. The difference between the Pennant and the flag is that the former forms a symmetrical triangle. So in the case of the flag, the price range of movement is calculated as the length of the entire flagpole. In the case of Pennant, the price movement is equal to the length from the bottom to the beginning of the formation of the symmetrical triangle. And so again, here we have the 15 minutes time frame chart of Ripple against US dollar. And so here it is a good illustration of a bullish and bearish pennant. In both cases, the price range of the movement is equal to the height from the support or resistance level to the beginning of the formation of a triangle pattern. And so the entry points in both cases are at the exit of the price from the triangle. Stop loss should be placed above or below the formed pattern depending on the movement. So now guys, let's discuss pattern-based trading strategies for short-term and intraday trading. So for day trading strategies, you can use all of the above chart patterns. Recommended time periods for market analysis are 5, 15 and 30 minutes time frame. In short-term investment strategy for 1 to 2 days, you can use the hourly chart. And so here we have a 5-minute chart of Euro USD, which is showing a bull flag formation. And so, after determining the price movement based on the flagpole and waiting for the price to exit the pattern, I opened a minimum buy trade of 0.01 lots with a specific target for the instrument. I set a stop loss inside the flag at the point where the growth started. Half an hour later, my trade closed with a profit of $1.62. And after analyzing the 15 minutes GBP USD chart, I identified the formation of the falling wedge, from which a breakout of quotes was expected. And so after the price broke through and tested the level, I opened a buy trade of 0.01 lots. As part of the trading strategy, the target for the instrument was at the distance from the beginning of the downtrend to the beginning of the first upward correction. And so the stop loss was set as part of the risk management just below the broken level. And sometime later, the trade closed intraday with a profit of $6.52. And so in parallel with two of other trades, there was also a buy situation in the 13-minute Euro USD chart. A symmetrical triangle has formed in the instrument. And let me remind you that within the framework of the trading strategy for the symmetrical triangle, the price can go both up and down. Therefore, you must first wait for confirmation of the breakdown. In addition, a bullish hammer formed at the base of the triangle before the start of growth, which was additional confirmation of the strength of buyers. And so, the impulse breakout of the triangle formed another confirmation pattern, and which was the bullish flag. After waiting for the exit of the flag, I opened a buy trade of 0.01 lots, setting a target equal to the height of the flagpole. And so the stop loss was placed below the former flag. The target was reached 1.5 hours after the trade was opened, and the profit was $3.14. And so that is basically how to identify, analyze and trade chart patterns. And so I hope you guys learned something out of this material. If yes, then be sure to leave a like and follow for more content like this. Right now, I wish you all the best and all the big profits. Thank you guys for watching, and I'll see you in the next one. Take care and goodbye.